Hi, it's Dave Dickinson with Bankers Compliance Consulting, and I want to talk about flood insurance and specifically how much insurance you have to have. Now, this is a complicated topic. First off, very illogical, but it's the lesser of these three things: your loan balance, the insurable value, and the maximum that you can get through the National Flood Insurance Program. Now, we all probably know about the NFIP limits: residential $250,000 and non-residential $500,000 for the most part. You plug that number in, but it's that insurable value number that can be complicated. There's a couple terms you have to understand: replacement cost value and actual cash value. First off, what's replacement cost value? It is what it would take to put it back just like it was before the flood happened. Here's the catch: it can only be used on residential dwellings and if it meets three conditions. One is it has to be a single unit, so duplexes, quads do not apply. Number two, they have to be fully insured, meaning they are within 80% of insurance to value at the time of loss for this to pay. And then third, it has to be their primary dwelling, where they spent 80% of the last 365 days. So even if you have a residential unit, if it doesn't meet those three conditions, it will not pay replacement costs. Instead, it pays actual cash value. What's actual cash value? It's replacement costs less physical depreciation. That's a very complicated number to come up with, because brick doesn't depreciate at the same rate that carpet does, or shingles, or things like that. This actual cash value is to be used whenever you have a non-dwelling or a dwelling that doesn't meet the three conditions that I talked about. But there are other methods that you can use to determine insurable value. If it's a non-residential, you can talk about functional building costs. So we have somebody that has a barn like this that's in a flood zone. Well, you're not going to put that back to the way it was, because they don't make them like that anymore. Instead, you're going to come up with a cheaper alternative, like a Morton or Chief Metal building. Maybe $50,000 or $75,000 might build you this. Well, then that's the insurable value of this old barn, because we can functionally put up this cheaper building and get back into operation. Or maybe it's a building that they're not going to put up. They don't need it to function. So what's the demolition or removal cost? What's it going to cost to bring in a wrecking crew and bulldoze that out and put it in the dump trucks and get it out of here? That's how much insurance you would need for insurable value. So once you have that part figured out, go back to your lesser of three. You got your maximum from the NFIP, you got your insurable value, and then you have your loan amount. Lesser of those three things, that's what you're going to use to determine the amount of insurance. That's exactly the kind of thing that we're going to be talking about over 4 hours, 2 webinars of 2 hours each, March 19th and March 26th. Jared Moyer and I will be covering flood insurance from A to Z, but we're going to get into the weeds on this complicated stuff. There's also been a lot of evolution lately with flood insurance renewals and notification requirements. And what if you force place and add that insurance amount, that premium, to the loan balance? Those are the kind of things that we're going to cover in this. So maybe you've been through flood training before. We're going to have the latest, greatest information for you. We'll see you on March 19th and 26th, and we're going to take this complicated regulation and turn it into plain English.